If your agency looks profitable on paper, but isn't based on agency gross income, you could be killing your deal before it even starts. I'm Cody. I'm a CPA, and I work with marketing and PR agencies doing $1 million to $10 million in agency gross revenue. I help them improve profitability, cash flow, and reduce taxes. Today, I'm going to break down why so many agency acquisitions fall apart, and specifically the accounting mistakes that quietly destroy deals. Confusing revenue with agency gross income. Here's the first and biggest mistake. Agency owners walk into a deal talking about revenue. Buyers don't care. They care about agency gross income. What's left after cost of goods, like media, freelancers, and pass-through, because that's the money that actually runs the business. Why does this kill deals? If your books show $5 million in revenue, but only $2 million in agency gross income, you've just overstated your business by more than double. And once a buyer figures that out, trust is gone. The solution is start reporting and managing your business based on agency gross income, not top-line revenue. That's what buyers value. That's what drives multiples. Misclassified expenses, cost of goods sold versus overhead. This is where most agencies get sloppy. They treat contractors, freelancers, and project-based costs as overhead. But in agency math, those are actually cost of goods sold. If you don't classify them correctly, your margins are completely distorted. So why does this kill deals? Because buyers rely on your financials to assess profitability. If your margins are inflated or inconsistent due to bad classifications, they'll either discount your valuation or walk away entirely. So what's the solution? Clean up your chart of accounts, make sure anything tied directly to client delivery is in cost of goods, and your numbers need to reflect economic reality, not just tax reporting. No clean or consistent financials. Many agencies don't have clean books. They have inconsistent reporting, cash versus accrual is confusing, no monthly financial reviews, and that's all a problem because buyers don't buy potential, they buy certainty. If your numbers aren't reliable, your valuation drops and it drops fast. As I always say, if you don't have good numbers, you can't make good decisions. And why does this kill deals? Because during due diligence, buyers will dig deep. If they find inconsistencies, even small ones, it creates doubt, and doubt will kill a deal. So what's the solution? You need monthly P&L reviews, you need a clean balance sheet, you need consistent reporting methodology, and this isn't optional if you want to sell. Quick question, what's your biggest frustration right now when it comes to your agency numbers? Drop it in the comments, I read them all. Another problem is owner-dependent financials. This one is subtle but deadly. Many agencies will look profitable, but only because the owner is underpaid, overworked, or doing multiple roles. Buyers adjust for that. Why does this kill deals? Because if the business can't run without you, your EBITDA isn't real, and buyers will reduce your valuation to reflect the cost of replacing you. The solution is normalize your financials, pay yourself a market salary, remove personal expenses from the business or show them as distributions, build a leadership structure, and your numbers should reflect a business, not a job. No visibility into cash flow. Profit is one thing, but cash flow is another, and buyers care deeply about cash flow stability. Remember, what keeps agency owners up at night is making payroll and having enough cash. Why does this kill deals? If your receivables are messy, if you rely on upfront payments to stay afloat, if cash flow is unpredictable, buyers will see risk, and risk lowers valuation. Or it kills the deal entirely. So the solution is track your accounts receivable, deferred revenue, your monthly cash flow trends. You need predictability. So here's the key takeaways. If you're even thinking about selling your agency, here's what matters. Run your business on agency gross income, not revenue. Classify your expenses correctly. Keep clean, consistent financials. Normalize owner compensation and build predictable cash flow. Get these right and your agency becomes attractive. Get them wrong and the deals will fall apart. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow and building a more profitable agency. I'll see you in the next video.